I'm going to show you an options hack on how you can get SoFi shares for more than 90% off. Now, this isn't a crazy idea. I actually learned this directly from a billion-dollar hedge fund manager, and I'm going to teach it for free to you right now.
So, the stock replacement, the basic idea is that you are going to buy a deep in the money call. Now, of
You've heard this before.
course, the question is how deep is deep enough? And we'll talk about that in just a moment. But you're definitely going to be going very deep in the money. When you do that, you're going to have a large intrinsic value,
You've heard this before.
right? As you lower that strike price on that call, it's gaining a lot more intrinsic value. But you're also going to have a very small extrinsic value.
You've heard this before.
This is really the key. We want to try to minimize this extrinsic value. Why? Because the extrinsic value is the option. And if we're trying to make this option behave like stock, we're trying to get away from making it behave like an option. And I've got another video in this forum talking about that. What makes an option?
Yeah, the volume is abnormally low on this. I don't know why. But yes, this is exactly what Chris talks about all the time. And we're going to show you with math how you can get basically 10 to 1 leverage. You can get 90% off your stocks by using this. It is such a hack.
An option. What is it that separates it from stock? It's the extrinsic value. So the basic idea is that the stock replacement attempts to go deep enough in the money to get a large discount on the stock's price,
Almost like 90% off.
but we still want to make the option behave like stock. So to see what's happening visually, let's take a look at this graph. And we're going to look at several different assets. We're going to consider shares of stock. We'll look at the 50 call, 70 call, and these various strikes. So let's say that the stock is trading for 100 right now, then the stock's price would come all the way up and touch 100 on our graph. And notice the size of this bar. It is reaching from 0 all the way up to 100. So you can think of that as that you are paying for 100% of the intrinsic value.
Okay, and so while we do this, I want to use this on SoFi. I want to use this as an exact today version on SoFi. So the current price of SoFi is 22.40 as of the time that I'm recording this. All right, so let's come over here. Let's put current price. 22.40. All right, so we understand where SoFi is at in the current price. So let's continue on with the video.
And I've talked about this in the pricing principles classes before. A share of stock is exactly the same thing mathematically as an option with a zero strike price. So if there were such a thing of a zero strike,
I never thought about that, but makes sense.
it means you could exercise it at any time and pay nothing and acquire the stock. And so what would be the value of that option? It would be the stock's price. It would trade for exactly 100, no more and no less. So we could also just as easily say that this is a zero strike. But when you do that, notice the size of this bar is very large. But what if we went to maybe the 50 strike? Well, the $50 call is 50 points in the money. So we have a lot less intrinsic value that we're paying. And because it's so deep in the money, it's virtually guaranteed to be exercised, at least by somebody. And
Okay, so in this case, let's go to the $11 strike. So if he's going 50% of the way, we'll do the same. So let me pull this up here. So the current price is here. This is the 11 strike. The current price of the $11 strike, we're always going to use the ask value. So we are consistent with everything we're doing here. $11.10. Okay, 11 cents. Now, how much extrinsic do we have here? And how much intrinsic do we have here? So the current intrinsic value will always be the price of the stock minus the strike price. So in this case, 11. I'll put this over here. All right. So the $11 strike, we'll move this around. There is $11.40 of intrinsic value. The extrinsic value is just the difference. So this minus this. Got my math right. Hang on. Maybe I got my math backwards. Hang on. Extrinsic value should be 8 cents, 10.90, 11.10. Oh, I'm looking at the 11.50. That's my bad. 11.90. There we go. That was my bad. So the current price is 11.90. There we go. So the intrinsic value is the strike price. I'm sorry, the current price minus your strike price to get your intrinsic value. And it should be 11.40. There we go. With 23 cents of extrinsic, that would be the mid price between these two. And so the extrinsic value is 50 cents when we use the ask price. Okay, everybody's following along. That was my bad on the typo. So let's continue on.
And because of that, because very few traders are really going to pay a lot for the right to walk away, there's going to be just a tiny bit of extrinsic value on this.
Right, that extrinsic value is very small. So let's do the percent extrinsic. So that would be extrinsic divided by the total cost of the option. Let's put cost here. All right. So this is 4%, 4.2% of the total option price is extrinsic. Now remember, extrinsic always, every time, forever, no matter what, on every strike, every stock, every expiration, no matter what, always goes to zero. Let me try and reiterate that point. It will always go to zero. This will always decay. So we want to pay as little of that as we possibly can.
So notice for this $50 strike, it is mostly green. And that's what's making it behave almost identically to stock.
Right. This is the moneyness value. This is the moneyness value. 96% of it is moneyness value. Let's do percent intrinsic. Let's do percent moneyness. All right, percent moneyness is going to be 1 minus that. So it's 95.8% moneyness. Cool, right? Makes sense?
The stock is obviously 100% green. This isn't far behind. But notice how much smaller the bar is. It's a lot less expensive than the stock.
Right. What is the price between these two, right? Let's do insert here, price delta. Price. If you ever wanted to do this, it's Alt 30 price delta. So it equals this minus this. All right. So we're saving $10.50 by buying the option. And it's going to behave 95% the same as the stock. Okay. Pretty cool, right? Let's also do price delta percent. Price Alt 30. That was the wrong button. Price Alt 30 and then add percent. Price delta percent. So it equals this divided by this. Lock that down. So this is 47% of the price of the option. Okay. Not quite 50%, but 47%. So look at this. We're learning a lot already. I love options deep dive Wednesdays. We can go real deep. Okay.
All right, well, that's good. Could we do even better by going to a little higher strike?
Okay, hold on. Actually, let me get the delta value because we're going to need that as well. That's a 95 delta. 95 delta. You know what? I may have noticed something I'd never noticed before. I may have just noticed. Did you notice what I just noticed? What is that delta? Anybody else notice it? 95.76. We'll see if that plays out. If that plays out, that could be a game changer for me. Something I just discovered while we're on this.
Let's look at the $70 call. It's only going to have $30 of intrinsic value. Now, because it's not quite as deep in the money as the 50 call, there's going to be a little bit more extrinsic value.
All right, so let's split the difference between 50 and 100 to make 70. So let's split the difference between 11 and 20. What would that be? 20 minus 11 divided by 2. So 4.5 plus 11. Let's go with the 15s. 1550s. We got 1550s right here. We'll take it. Okay, cool. So now we're at the 1550s. Ooh, I love this stuff. Oh my gosh, I can nerd so hard on this. All right, so this is a 1550 strike. So we're going to write 15 here, okay? The cost of the 1550 is what? $7.25, okay? $7.25. The price difference between here to here, let's lock that down, boom, is $15, okay? So we're paying $15 less to buy this option for this stock that costs $22.40. Now the price delta should work, yes, okay. Extrinsic, that's a formula. Intrinsic is a formula, but what is the... Let's see. Did I copy this right? No, let me lock that down real quick. All right, very cool. And I should be able to copy this over. Did I do that wrong again? Let's double check that I got it. Oh, I did. Okay, 1550. See, it helps when you type in the correct numbers. Then we can copy all this down, except we're going to get the different delta from the 1550 is 94.39. Oh man, I'm telling you, I may have learned something here that the delta equals the moneyness of the stock. That would be such a cool revelation to see as we go through. By the way, if you are enjoying this, do me a favor. If you love to nerd out on options like this, or that we are learning together, in fact, let's make this 2 decimal places. There we go. Will you put a gas pump emoji in the chat? Let's put a gas pump emoji in the chat. Will this video be saved somewhere? Only on YouTube forever. Only on YouTube forever. In fact, this video has a full money back guarantee if you don't learn anything at all. Let's go.
So in total, the red plus the green is the option's total price. Remember, intrinsic plus extrinsic is the option's total premium. So this entire box, red plus green, is smaller than it is for the 50, but we are paying more for the extrinsic value. This is
okay. So we're paying more for the extrinsic value. All right. Not a lot more, 4.2 versus 4.8%, but we are paying more as a percent of the total in the option value, right? The extrinsic is not very much, but as the total price of the stock, we're paying more. Okay, let's continue. Oh, we're learning a lot today.
where the balancing act comes in for stock replacement. We want this to be largely green, but we're willing to accept a little bit of red. And we're just trying to minimize the height of this box. Let's go to the 90 call. $90 call has $10 of intrinsic value. Well, that's not super deep in the money. And so it's going to have a much higher extrinsic value.
Okay, cool. So let's go to 90% of a $20 stock or $22 stock. 90%, 22 times 0.9 is 19.8. Let's round that down to 19.5. So we're going to look at the 19.5 strike on SOFI, which is the 94 delta, 94.10, 19.5 strike, 19.5 strike, 19.5. And the cost of that 19.5 is $3 exactly. Okay. And the price changed $19 less than buying the stock outright. It's 87% less than buying the stock outright. Let's copy these down. It's 10%, I'm sorry, 10 cents of extrinsic value in this case. The intrinsic value is $2.90. So let's confirm my numbers over here. So that's the mid price, $2.90. Yeah, we're good there. Okay. And it's 3% extrinsic. So it's actually slightly less. Moneyness, 96%. And 94.10 on the delta over there. This is really cool. All right, let's keep going.
So yes, in total, this entire box, red plus green, is smaller than it is for the 70 strike, but we're now starting to incur a lot of extrinsic value, at least relative to the intrinsic value.
Now, as you can see, right, this isn't playing out exactly the same as his example with a 4.2, 4.8, 3.3, but it should be a little bit higher. That particular option is actually a really good deal. However, as we go through, as we get closer to the money, this should play out closer to his explanation here.
That's becoming a problem. And that means that this $90 strike isn't really behaving like stock. What if we look at the 95 call? It's only got $5.
All right, let's move up. Let's move up to the, let's do the 20.5. We'll go from 19.5 to 20.5. Right, or should we go up to 21? Let's just jump up to 21. Let's just jump up to 21 strike. All right, so we're at $21, and the cost of that option is $1.63. Okay, 1.63. The price delta is $20.77% or $20.77 less. It is 93% less than the current price. Okay, 93% less. The extrinsic, intrinsic, there we go. All right, so now we're starting to pick up on that extrinsic that he was talking about in the video, right? Like I say, that one's actually a really good deal, but 14% makes more sense. This should grow as you get closer to the money, the percent of extrinsic to the total cost of the option, okay? Ooh, I love this stuff so much. Okay, so now the delta, what is the delta on this? 82.41. 82.41. I swear we learned something today. Oh man. So the delta represents the moneyness of the stock. I am so stoked that I learned that today with you. How cool is this? How cool is this? All right. So it's $1.40 in the money to go with the 21 strike. Remember, it's 22.40 current price, $21 strike price. So it's $1.40 in the money. It's 85% moneyness because only 14% of it is the extrinsic value that will decay to zero. And you can buy this for literally 93% off the current price as if you bought the stock outright. Okay. If you bought the stock outright, you would pay significantly more. It's 93% off the current price. Oh man, this is so cool. This is so, do you see why I love and will only trade deep in the money options? Let's keep going.
Of intrinsic value, but it's going to have a lot more extrinsic value. What about the 100 call? No intrinsic value.
Remember, this is at the money at this point. So we're going to skip up to the 22.50s. 22.50s in this case is the at the money. Okay. So this is where things start to break. If you're an options trader and you trade at the money or out of the money, you're doing it wrong. This is 22.50. The cost of the 22.50 is 57 cents. And all that filled in on its own. Very cool. And you'll see here intrinsic breaks. Intrinsic breaks at that point because it doesn't have any intrinsic value. It doesn't have any intrinsic value. In fact, it's all extrinsic value. And the formula is actually going to break right there. So if we look, it's 57 cents ask price. It has no intrinsic value. It's 22.40 current price, 22.50 actually is slightly out of the money, even though it's at the money. So that means every bit of it, all of it is extrinsic value. So we have to change our formula here. So we'll just type 0. So all of that is intrinsic value. All of it is, I'm sorry, extrinsic value. There is no moneyness to it. And then the delta is going to be 48. Okay, so the delta represents the moneyness as long as it's in the money. If it's out of the money, it's useless. Delta at the money or out of the money doesn't show you how much moneyness it has. Wow, look at this. We're learning so much. Okay. Lottery tickets do have their place in some strategies. I guess you're right. Okay, let's continue on.
Value at all, and it's all extrinsic.
Right, and we just calculated that. Remember, I had to fix my formula here because it broke. I'll just do that, right? All extrinsic, meaning all extrinsic has no moneyness to this. No moneyness at all. It is not in the money. If it expired today at this very moment, it's worthless. It is worth less than my new prop, which is a pressed penny from the Houston, what is this? The Houston Museum of Natural Science. It is worth less than this rhino pressed penny that I got from the Houston Museum of Natural Science. That is how worthless it is. All right. I need to convey. It doesn't mean it's worth less. It's worthless.
So again, notice that this box, even though it's all red, is smaller than the red plus green. So that just means the $100 call costs less than the 95.
And that really is the percentage of the option price that is extrinsic, right? We saw as this was growing, like I said, this one in particular was actually a really fantastic deal, but it should be growing as it goes, right? And so if it's at 100%, there's nothing green about it. Nothing green about it.
But the proportion of the extrinsic value is a whole lot more. This is an option in its purest form. What about an out of the money option? What if we look at the 110 strike?
All right, so if we go 10% out of the money, that gets us to roughly, let's go with the 25. Let's go with the 25. What a piece of junk call this is. All right, the 25 strike, where 27,000 people were have open interest on that. The 25 strike is costs 7 cents. So let's do the 25 strike. Current price of that 25. I should say strike price. Okay, strike, $25 strike. They all need to look the same. Okay. Cost of that is 7 cents. 7 cents. And the delta on it is 8. 8. 8.4. So you can see, right? All we did was literally like walk up the street, right? This is equivalent to walking down the block and you see big, beautiful house, amazing house, pretty decent house. This doesn't look like that great of a house. This is a crack house, right? All we did was walk down the street, just like walking up the options chain here, going from the most big, beautiful mansion you've ever seen to a crack house riddled with bullet holes. All right. All of this is on the same street, meaning you have all of this data and you have always had all this data right here at your fingertips. But choosing the different strike makes all the difference in the world, right? Do you want to buy something that is absolutely worthless, hot garbage, and you don't want to be seen around it? Or do you want to be walking around in opulence? I prefer opulence because, as you guys know, I am a snob. I prefer opulence all day, every day. So I'm going to be buying these type of options. And if you're the one buying these type of options, you're doing it wrong. This is why I like to teach these videos. All right, let's keep going. Hang on, let's keep going.
Well, it's going to have a very small time premium. So its total premium gets smaller. The size of this box is smaller than any other on the board. But
Okay, Mike, that's funny. Trading the 8 delta. I can change her. I can change her.
it's also all extrinsic value and it's also out of the money. We need the stock to move 10 points just to get it at the money. So there's a very slim chance for this option to be exercised. In other words, there's a very high probability for people to walk away from the deal. So, yeah, people aren't going to be paying a lot for this option. So the
And
thing
that's why this option is 7 cents versus this one. The most likely one I would buy is this one here. Right. In fact, let me highlight this one, and everyone's going to be different, right? This guy explained in the video, he may say a completely different one, but this is the one that Chris usually focuses on, right around the 80 delta. And this is how much percent more equals this divided by this. So no, I did it backwards. This divided by this. So it's 23 times more, right? This is your snob factor. All right. I, as a snob, because I only buy the opulence in my trading, and I would suggest you do the same, is I will buy the option that's 23 times more expensive than the one you would if you're buying the 25 strike, right? Now, by all means, if you want to throw your money away, go ahead and do so. You can buy 23 times as many option contracts as I can for the same dollar price. It's a fact, right? However, why? Right? You are so much more likely to have this be worth absolutely nothing than I am. Here, you're probably 10 times more likely for it to be worth nothing than I am. Right? I want you to live in the snob factor. All right? I want you to be totally content with the fact that you're paying more because they are worth more. If you're paying for these, you're paying less because they're worth less. All right? They're worth less because they're worthless.
thing that you want to understand for stock replacement is when we're looking through all of these strikes or all of these different assets, which one is mostly green, but also gives us a very small premium. So if we look at the $50 strike, it's obviously mostly green, very tiny extrinsic value, that red sliver right there. But if we look at the 70, it's a whole lot less, and yet the extrinsic value isn't all that much more. So between these two, both of these would be good candidates for stock replacement, but because of the additional leverage and protection from the downside, if the stock should fall, I would lean towards the 70. $90 call has way too much extrinsic value relative to the intrinsic. Same for all of the others, all the way up the board. Way too much extrinsic value. And in this case, you've got extrinsic value plus an amount that's out of the money. That's not saying that these are bad options. They can be
No, they're definitely bad options.
awesome selections for different strategies, but not for stock replacement. Stock replacement, we want the entire box to be fairly small, but also constrained to keeping this red portion small.
Okay. So what he's trying to say is you want to pay as much intrinsic value as you can and pay as less extrinsic value as you can. And you do that by just doing a little calculation, right? How much extrinsic value is to the total price of the option, right? So $1.63. Now let's also talk about like the point of diminishing returns, okay? Because by going from the 21 strike up to the 1950, right? So that's let's just do calculations here. Equals this minus this means you're paying $1.50 more for this one right here. Let's highlight this one. Let's highlight this one orange. You're paying $1.50 more. I'm sorry, you're paying this much more. It's not $1.50, it's a little bit more than that. In fact, let's do this. Equals, I should just be able to roll this over. You're paying $1.37 more. Paying $1.37 more to go from this one to this one. But you're only gaining, how many deltas is that? How many deltas is that? You're gaining 11 deltas. Okay. So you're paying $1.37 more, but you're only gaining 11 deltas. So in this case, it doesn't make sense to me to do this because you're paying, what is the percentage? Like, in fact, let's do this. Equals negative this divided by this means you're paying 84% more. You're paying 84% more to gain just 11 deltas. Okay. So you could nearly buy 2 of these. In fact, let's do that, right? Let's say if we bought 2 of these, this times 2, what equals this times 2. Why is it doing? Oh, my numlock. Okay. Equals this times 2. There we go. It's $3.26, which is only slightly more than this. But what is the total deltas you get for that price? Now, remember, in fact, I should probably explain this. Delta is the amount of change in the underlying stock for every $1 move in, I'm sorry, the amount of change in the option price for every $1 move in the underlying stock. So if SOFI moves up by $1, this option gains 82 cents. If SOFI goes up by $1, this option gains 94 cents. Okay. Chris is really nerding out, and I love it so much. This is so my jam. I'm not sure if you can tell, but I love it. So because of that, right, we're moving from here to here. It's only 11 cents more that you're going to earn for every dollar it goes up. That's not very much. Okay. However, if we bought 2 of these options for $1.63, our total deltas would be this times 2 versus it's still just this right here. And we only paid 26, how many cents more? 26 cents more. So $3.26 versus $3, right? So how many more deltas did we get for basically the same price? We got 1.75 the number of deltas for pretty much the exact same price. So what I'm trying to say is there is a point of diminishing returns where you're paying so much more in the intrinsic value that you're not capturing that much more in the deltas. Okay. And this is a perfect example. You're paying, you could basically double your position size for nearly what the price would be for this one. And yet you have 175% of the deltas. So basically, the cost is roughly the same between the two, having 2 of these versus 1 of these. You're getting 75% more deltas, and it costs you only 26 cents more. There you go. I love this. I love this so much. Now, this is why whenever I trade, I go deep in the money, because this allows you to get the same leverage as if buying 100 shares of stock for basically a 90% discount. For basically a 90% discount. Now, how does that work as well? If we did this times 100, right, it would cost me $22.40 in shares. It would cost me 100 shares. 100 shares would cost me $22.40 out of my account. Okay. But if I went with the green one here, it would be this times 100, which means I would only pay $163. I would still control 100 shares, and I would do that for what price? 7%. 7.3% of what it would cost to own the 100 shares outright. Isn't that cool? Isn't that cool? I love this so much. And this is why this was one of the best lessons I ever got from one of my mentors, Larry Hite. This is why he was $1 billion hedge fund manager. And this is why I love to share this with you, because I just showed you how to get a 93% discount on any stock you want to buy by choosing the right option strike. Now, is it perfect? No, because you still have to pay the extrinsic value. But if you minimize the extrinsic value to as low as possible, then you are getting all this leverage with as little downside as you possibly can, and still getting a huge, huge discount on buying the stocks outright. Remember, you can buy 100 shares of stock on SoFi, it would cost you $22.40. Or you can buy 100 shares by one option, 182 delta option right here, and it'll cost you $163. Pretty sick, right? Pretty sick, right? Pete says, this is one of the best lessons Chris ever got. Well, you are very welcome. Now, if you are ready to save time, make money, and start winning with less risk, I do this stuff all day, every day. So we go live twice a day, every day. I don't want you to miss out. Click one of these two videos, and we'll talk soon.